Namaskar. Yesterday we had the budget, Union Budget 26-27. It's going to come into effect on the 1st of April. Entire financial year it will last. And it's widely praised. We'll discuss it for the Union Public Service Commission. Be it whatever the stage of your exam, preliminary, main, interview, should be useful. First we'll discuss the constitutional context. Then we'll discuss various themes of the budget. And finally, I'll wait for your questions and I'll answer them. So let's get started. The Union Budget is presented according to Article 112. Article 112, this is the outline. We'll talk of the Constitution, then we'll talk of the global context, then we'll talk of the various aspects related to, everything, whatever matters for our purpose. We're going to constructively approach this. So, Article 112. Next slide. Article 112. You have seen the photo yesterday of the Honorable Finance Minister with the Honorable President of India, because under 112C, the President of India is responsible for getting the annual financial statement. That is the receipts and expenditure. That is the annual financial statement in the Parliament. It goes without saying, Lok Sabha. So, in that, there are two aspects which are important. From your exam point of view, one is you are showing the money that you receive, the money you are spending. In the budget in 112 article, it's clearly stated that you have to separate between the revenue account from all other. They don't mention capital expenditure there at all. We know revenue, and apart from revenue there is capital. So revenue and other. They don't say revenue and capital. They say revenue and other. That's Article 112. And then we'll go into the revenue and capital of the 26-27 budget when we get into the budget. The expenditure is two classes of expenditure. One that is charged. For example, the salary given to the honorable judges, that is charged. You can discuss, but you can't vote. That is fixed. Unless you amend the Constitution and say it is not charged. As things stand now, all that is charged. You borrowed money, you have to pay interest on that. You can't negotiate. That's the interest you have to pay. You're committed to that. Charged. Discuss. Can't vote. Rest of the expenditure is called demands for grants. So, demands for grants and the voted expenditure. We'll come to Article 113 for that. Charged upon the Consolidated Fund of India. You have to pay. You have no choice about that. That is charged on the CFI. Rest is, votable. Charged is not votable. Open to discussion. Rest is votable. All the votable expenditure would be called demand for grants. That is the executive demands of the Lok Sabha. You grant me this amount. I have to implement so many schemes in the budget. So these are the two classes of expenditure openly acknowledged, authorized in Article 112. And for the entire exercise, it's a president who is responsible. Now let's see the photo. This is the photo. And after that, she is also shown to be feeding her some sweet. So the Honorable President, Honorable FM, both of them, yesterday, before she presented the budget, she went to the Honorable President, showed her the budget, and after getting a green signal, she proceeds to the Parliament. So that is 112. Let's get the 113. That will also show you quite a bit about the So charged, this is called the procedure. Article 113 tells you the procedure. Charged and demand for grants. Both of them are introduced in the Lok Sabha only. Charged is non-votable. Demand for grants, votable. In the demand for grants, the Lok Sabha, approve, you can. Reject, you can. Reduce, you can. Can't increase. If the Defense Ministry has to get 7.85 lakh crores of rupees, that is the demand for grant you are showing, Lok Sabha can say, let us make it 6 lakh crores. Let us spend a little more on the capital, etc., etc. No, we will not spend anything on this. Cut motions, all that. But Lok Sabha cannot say, let's increase it. That is up to the executive initiative only. This is the classical question for the preliminary. A demand for grant can be approved, rejected, or reduced, but Lok Sabha can't say, let's increase it. So you've cleared the charge, that is cleared. Demands for grants you have cleared. And demands for grants can be introduced in the Lok Sabha only on the recommendation of the President of India. These are the rules in 113. This is the procedure. So this is through. So charged and the demand for grant, both you cleared, and the entire amount asked by the executive is cleared. 114 comes. In the 114, it's an appropriation bill. Every paisa you want to draw from the CFI, you can do so only by having an appropriation bill passed in the Parliament. It's a bill. So every bill involves the Parliament. Appropriation bill is a money bill. Money bill is introduced in Lok Sabha, goes to Rajya Sabha, stays there for a maximum of 14 days. Rajya Sabha can do whatever it likes. It can even suggest amendments. But finally, it's up to the Lok Sabha to take it or leave it, and then comes back to Rajya Sabha. The power of Rajya Sabha is consider and return, comes back to the Lok Sabha, and then goes to the President, etc., etc. So appropriation bill is a bill that seeks to draw money from you already cleared all the 100 rupees they wanted. This budget is 53.5, almost 54 lakh crores of rupees is the total expenditure in the budget. All that you already cleared, and appropriation bill is brought, and with that the Parliament permits the executive to draw so much. That's a constitutional background to the union budget. 112, 113, 114. Now let's get into the current event, which is the union budget 26-27. Here, the first thing that strikes you about this budget, it technologically heavy. It also strikes you as fiscally very prudent. It strikes you that the government is struggling for money because of various aspects. It also strikes you as, it strikes you as something responding to the global headwinds, geopolitical, geo-economic, both. That's very, very clear. So, very clear, crystally clear. I'll show you. So, this budget and the geopolitics and geo-economics. First, the defense expenditure goes up to 7.85 lakh crores of rupees. That is huge jump over last year, point number one. Within that, the capital expenditure, buying the ships, the naval fleet and aircraft and drones and all that, that also jumps up massively, point number one. Point number two, remember, in these days of chips and AI, unless you are on your own, you will be held to ransom. We are seeing so many countries do it, particularly America and China. And therefore, technological sovereignty is given premium in this budget. For example, Semiconductor Mission 2.0. We'll come back to that. So technological sovereignty is also a response to the way the world is running. Point number 2. Point number 3, responding to the geopolitical events would be Chabahar is impossible. You can't get there as of now. Tomorrow something happens and a regime changes in Iran and that is pro-America, in which case America may allow us to access Chabahar, etc. So you know how much this budget allocates for Chabahar development? 0. Nothing at all. And how much Bangladesh gets? 60 crore, 60. Massive slash. How much Bhutan gets? Bhutan gets the maximum, almost about 2,500 crores, etc. Nepal also gets. So this is immediately responding to the neighborhood and the global developments. Think of critical minerals, rare earths, how China is having a stranglehold over the critical minerals, the rare earths. Critical minerals are what the government decides, 30 in India. Rare earths are a geological fact. Rare earths are not rare, but in a given material, very, very minute quantity is there. Processing is very difficult and environmentally very ruinous. Very difficult, very little portion of it is these minerals, therefore you call them rare earths. So this budget tells you from Odisha to Kerala, the entire coast constitutes rare earth corridor. So resources, we have seen critical minerals and rare earths and how they are weaponized. So it's a response to that. We have seen AI and chips, response to that. We also have seen neighborhood Bangladesh, we have seen Chabahar, Iran, anything may happen there. So this budget, I have given you 4 points to show that, is a direct response to the geopolitics and geoeconomics. Resource self-reliance, technological sovereignty, massive defense expenditure increase, plus of course the neighborhood juggling with money you give to the small countries who make up our immediate neighborhood. Let's get the graph, the infographic slide. Oh yeah, it's here. Before defense, massive, technological sovereignty, the rare earth corridors, and of course the neighborhood policy. See how much Chabahar gets. Paused, 0. Nothing we are giving this fiscal year. It can change if, right now we don't know what's going on in Iran. Anytime, anything can happen. We have no idea what's going on. The whole world is on tenterhooks. Tenterhooks. And while we are talking, maybe it's possible something dramatic could happen, etc., etc. So this budget is a response to all that. So geopolitics, this would be geoeconomics. This would be geoeconomics. And this is, of course, geopolitics. Geoeconomics is all this critical minerals, tariffs. In fact, you can add one more also for geopolitics and economics, geoeconomics. We have reduced the customs duties on the feed for your shrimps and fish. Because see, the people who are exporting shrimp to America, they are not able to export so much anymore. That's because the tariffs have jumped up to 50%. And therefore, you have to cut the cost of creating the shrimps for export. Part of the helpline you have operated is cut the import duties on the shrimp feed. That helps. And also the fish that you catch in the international waters, if you are an Indian, and bring the fish back into the country, that will attract no duty at all. So this is also a response to the Trump tariff tantrum. So this is one aspect of the budget that strikes you directly. It is responding to the world. What the economic survey calls strategic resilience. Semiconductors are strategic resilience. Rare earth corridors are strategic. Strategic means long term. Resilience means you can withstand the shock and bounce back and get stronger. Every shock is a challenge. You're never flattened by any shock. That is the resilience. So this is about another aspect of the budget. Next would be, this budget, what struck me about this budget is, they're very serious about modernizing the economy. We are talking about data centers. Okay, there's a data center coming up in Vizag, let us say Visakhapatnam. There you have the servers. Those servers are providing cloud services to global investors. You make money on that. Until 2047, that kind of a profit is non-taxable. Tax holiday, no tax on that. On the profit that you make by offering cloud services to the global investors via the servers in the data center that you have set up. Wonderful. Data centers are the technology, AI, everything runs on that. That is Sunrise. What is Sunrise? Sunrise is up and coming number 1, contributing massively number 2, with great potential number 3, tremendous future, that is great potential, employment, exports, etc. That is Sunrise. And the most recent sector designated as Sunrise is fisheries. There also the budget provides resources. So critical minerals is one, semiconductor is another, data centers are one more, and also the application of AI, AgriStack and Indian Council of Agricultural Research are linked. Farmers are enrolled there and they get AI generated as latest as it gets information so that they can apply it and their incomes are boosted. So for agriculture and for nuclear energy, whatever materials you are importing for your nuclear plants, tax free. And if you are in the cement or steel or aluminium, some of these 2 sectors, the carbon that you are emitting will be captured. Carbon capture, storage, utilization. So carbon capture is state of art. Agriculture, I have told you, critical minerals, rare earth corridors, data centers and semiconductor. Semiconductors for chip making, we had 3 years back we started. Massive amount of money. That was 1.0. Attract capital, set up factories, essentially to assemble. For example, in Gujarat, what does the advanced material AMD do? What does Micron do? They assemble. But in this, the semiconductor mission 2.0, you are likely to make plants, you are likely to set up plants that make machines that will make the chips. 2.0, value addition. One is foundational assembly. Second is value addition. Yesterday I was hearing the government minister talk about fact that Indian government is in talks with ASML, Netherlands, a Dutch company. That's the only company, ASML, you will see it later, that's the only company in the world that makes machines that create the chips. So, TSMC, Taiwan Semiconductor Manufacturing Company Corporation, that is there in Taiwan, TSMC. But TSMC gets its machines from ASML, lithography. So we are in talks with ASML. TSMC, of course, is, it will make the chips. So we are scaling up value-wise on the semiconductors. So all this is sunrise sectors. Sunrise, future potential is amazing and critically important for us. So yes, I've just made a case that this budget is the one that modernizes our economy, keeps the economy future ready. All these are examples, and one more example I'll give you. Biopharma, Shakti for healthcare, non-communicable diseases like cancer, diabetes, etc. It sets up centers for pharmaceutical research and education. It also ensures that the quality of the drugs made in the country is high. All this is under biopharma, biotechnology, biological similars. We want India to be global hub in that. So yes, this is absolutely awesome incorporation of state-of-art technology priorities. Let's get the graph. Here, sunrise, 1 lakh crore, research, development and innovation, semiconductors. I've told you about agriculture and AI, AgriStack and ICAR come together. We discussed carbon capture, nuclear energy customs duty exemption for all the small modular reactors, Bharat modular reactors. Solar power, of course, PM Surya Ghar. Next one. Critical minerals, I told you, from Odisha, Andhra, Tamil Nadu and Kerala. Karnataka is skipped. Biotechnology and pharma we talk. Data centers, fisheries, formally recognized sometime 2021 like that. Fisheries is getting massive support. And you see, electronic components manufacturing scheme gets 40,000. You know how you read all this? Semiconductor Mission 2.0 linked to rare earth corridors, which is again linked to electronic component manufacturing mission. All three have to be read together. You will see it in the table. That's because how do you make the chips? You require the critical minerals, and for that rare earth corridor. And take that to the next one, which is electronic components. Today we are importing all that, but last year we started the electronic component mission, a manufacturing mission, and this year we scaled up almost double. So the three have to be read together. When you mention one, the examiner looks for the other two. If you get him to see all three, then you are the winner. Textiles, okay. This is the big deal. Orange economy, AVGC. AVGC, animation, visual effects, gaming and comics. This is the sunrise sector, and what got me thrilled was 15,000 schools in which you will have AVGC laboratories. Creator labs. Amazing. Indian kids are raring to go. They want to explode with new technology, new knowledge, innovation on the global stage. 15,000 schools, I can see Indian kids flying across the world with this. Now they are bottled up. They are tremendously curious and innovative, but where are the avenues? This will set them free. So this orange economy, the creator economy, gets a stimulus in the budget, which is wonderful. Sunrise. The next one. Yeah, please. Semiconductor mission 1.0 and 2.0. I have told you all these things. Chemical parks also. Rare earth corridors. Electronic component manufacturing scheme has been there from last year. Machines that make chips, ASML. ASML, lithography. You make the machines that create the chips. ASML is the only company in the world that makes this. So this is semiconductor mission 1.0, 2.0 contrasted, which is actually scaling up, deepening and widening. Next. This is ASML, awe-inspiring, totally mind-boggling, absolutely. What they make it's a bit technical, but you can always break it down. I'll put up some material on for our students, ASML. This is a Dutch company. And then this is, where is the TSMC? TSMC, Taiwan, semiconductor, manufacturing, company, corporation. This is the place, China is not a fool to compete for water capture at Taiwan. This is in Taiwan. And they make about 90% of the chips for NVIDIA, for Alphabet, for your OpenAI, Claude, all of them get their chips made here. The latest, most advanced AI chips. Of course, they are designed in the ASML and then produced here. All right. So the company NVIDIA designs it. And to be able to make the chips, they import the equipment from ASML. So there is IP, intellectual property, is of course with NVIDIA. Yeah. Next slide. Yeah, biopharma. This is just for reading. There's nothing, whatever I, these days if you are taking cough syrup from India, you're, taking a risk. So, CDSEO standards are being strengthened, global standard. And for clinical trials, you got 1,000 institutions nationwide. I told you, National Institutes of Pharmaceutical Education and Research. You're setting up more of them. 3 more. Non-communicable diseases, we have discussed it. Cancer, diabetes, autoimmune, etc. And then 10,000 crore, humble amount, but that can crowd in a lot of private investment. So, it can multiply. So this is about biopharma Shakti, just information based, nothing to understand here. Next. Yeah, from now on we are digging into the budget, the fiscal math. See, about a month back or 3 weeks back, you got the statistics about Indian economy growing at 7.4. That is the real. Add to that 0.5, which is nominal, all that. So nominal is what? GDP at current market prices is nominal. And current market prices means from last year to this year invariably there is inflation. Deflation is exception. Inflation is the norm. So at current market prices, the value is X. And it may mean more production or it may even mean less product. So for you to understand what is the actual value addition to the economy, you value what is produced in the economy at last year prices. So if you produce 10 cars, last year 100 rupees, this year the nominal GDP is 120, you can't automatically assume there are 12 cars. So if you can, the current nominal GDP, the number, you reduce it by the level of inflation between the same point of time last year and this year. So 120 minus how much? 4%, 2%, 3%. So take away 3% of 120 and whatever the number you get, that is the real GDP. That is the actual production. Rest is inflation. So real plus inflation is nominal. Nominal minus inflation is real. So you want to know how much you actually produced, you cut the inflation, the noise of inflation from the current market price based GDP. That is nominal. So, last year nominal growth was less than 8%, 7.8, 7.9% last year. You will grow because you are investing so much. So this year, last year you assumed 10% plus, but you didn't get there. Global headwinds and so on. So this year you are assuming 10% nominal. That is, your economy is going to be worth about 3.93 crores. Not 4 crores. Divide this by the value of the rupee, you will get the value of the GDP in dollar terms. 3.93, let us assume 4 and divide that by, let's say rupee is 90. So you are arriving at 4.5% trillion USD. And remember, the more the rupee slips, the lesser will be the value of the GDP in dollar terms. Because divided by 9 is 4.5. divided by 10 is equal to 4. 10 is 90 here, is 100. So as long as the rupee depreciates, you are seeing the erosion of the value of the GDP in dollar terms. That could also be a good prelim question. Now, so there is nominal GDP, you are assuming you will grow at 10%. Remember, nominal GDP is very important. You know why? Your target of fiscal deficit is, if your nominal GDP is 100, you're targeting 4.3% of the GDP. Nominal GDP is 100 rupees. 4.3% of that is your fiscal deficit for 26-27. If you slip on the nominal GDP, it becomes 98 rupees. 4.3 is equal to how much? 4 rupees 30 paisa. So if your nominal GDP is 98, the same 4.3 will be maybe 4 rupees 20 paisa. So how much you can borrow depends upon the size of the nominal GDP. Nominal GDP matters because I bought a bottle of water and the tax on this is 5%. If the bottle of water is 100, 5 is 5 rupees. If the bottle of water nominally, current market price is 150, 5% is 7.5 rupees. The government will get 2.5 rupees more of GST if, I'm not recommending there be more inflation. I'm saying you produce more and real growth and all that. All I'm saying is that nominal GDP matters critically to estimate your fiscal deficit, to get your tax collections. If Bisleri sells more, he'll pay more corporate tax. The owner will pay more income tax. The company will pay more GST and so on and so forth. And if he plays around in the stock market, he'll pay more of capital gains. If he diversifies to gold, he'll pay capital gains. And if he is one of those guys who are playing around in F&O, he'll pay more of STT. So everything is nominal. Real is real, of course, but your deficit, your debt, your tax collections, they all depend upon nominal GDP. And I just now gave you the example, 4.3% of your nominal GDP is the fiscal deficit target for you, upcoming fiscal year, 26-27. If the nominal GDP you don't make 10, you make 9, imagine the number falls and the amount of money you have to, you are allowed, the fiscal deficit, only that much you are allowed. Earlier you could borrow 4 rupee 50 paisa, nominal GDP was whatever. Nominal GDP shrank, you could borrow less, which means less of roads, less of rural employment, less of irrigation. One of the railway corridors among all the 7 high-speed corridors may have to be held back. So nominal GDP is very important. That doesn't mean you inflate the economy. It means boost your real economy. Goldilocks, we are all familiar with the term Goldilocks. That is, inflation should not be too low. Growth should not be too high because that overheats. And this threatens you with deflation. So, 7.2% growth and about, say, less than 2% of inflation. It is moderate. It's not extreme. This is Goldilocks. Neither too high, nor too low. This is Goldilocks. So yes, nominal growth of 10, economic survey, all of us know, projected a real economy growth rate of 6.8 to 7.2. And if you are taking the lower number, 6.8, then your nominal is 10. You are assuming an inflation of 3.2%, which once again keeps up the Goldilocks moment for you, which is wonderful in the world. If you look around, China is in deflation. China isn't growing at home. That is why they have to export and survive. Whereas we are a country where there is Goldilocks. You're telling the world we are the fastest growing major economy, large economy. 7.2 is very impressive. So I'm trying to show to you that nominal is this and the importance of the nominal, etc. If you could care, 7.4, real. This is real. I've explained everything here. Here I've told you 393 trillion. Rupees 393, that means 393 lakh, which means 3.93 crores. I've explained all this here. You don't have to remember all this, please understand. I have to tell you all this so that, even if you remember half of it, you are the winner. So debt to GDP ratio depends on nominal. Fiscal deficit depends on the nominal. Everything that the government requires, tax collections, everything, that is all nominal. Everything is nominal here. Though, real is more important, because that is what you are growing. That's what you are producing. That's what you are consuming. That's what fetches you the wage. That is what fetches you the profit. That is real. But we are talking about government finances for which deficit, debt and tax collections, all that depend upon nominal. So 10% is what they are assuming. I just hope the world is going to be stable because you had enough disorder. Even the most stubborn and self-destructive people will realize that we can't go on like this. Then there could be growth, in which case 10. Also remember, on the 27th of February, the new National Income Series will be released. New base year of 22-23. So maybe that will show that you are growing faster, you are undercounting your production. Maybe, in which case your nominal could end up at 11.5%. In which case your 4.3% of the fiscal deficit target for the fiscal year, you could spend a few thousands of crores of rupees more, which is good for the economy, investment and manufacturing, services, employment and all that. So we have to wait, suspend our further analysis till the 27th of Feb about the nominal part of it. Next. Yeah, this budget, this is very interesting. Listen to me very carefully. Debt to GDP ratio. How much is the union government? We are talking of only union government as of now. How much is the union government borrowing? Borrowing about 56% of the GDP. Borrowing means, today, the public debt of the union government, we are not including states. Union government is today 56% of the GDP. GDP being about, take away 10% from 393, you will land around 3.5, 3.6, 56%. You are looking at about, say 200 crores, that is your public debt. What you have accumulated. Every year you are borrowing a buck and you are only paying interest on that and a little bit of principal also maybe. So overall today the government of India has 56% of it, the GDP as its public debt. It owes to the people, it owes to the RBI, it owes to the people abroad also, investor, whatever. All types of borrowing of the government of India, internal, external, all that. Government of India. So now all over the world, take America, GDP is about $37 trillion and its borrowings are about 40. So 100 plus. Japan 200 plus. China whatever. France 100 plus. We are only 56. So you want to have a fiscal anchor to show to the world on a comparable basis what is the level of government borrowing. If you say annual deficit 4.3, they will not know anything. 4.3 this year. But how much are you sitting on? Is that a time bomb? Or are you comfortable? Are you fiscally well behaved? For all that, for the world to know, you need to express your liabilities in the form of debt to GDP ratio. France does it, Japan does it, China does it, America does it. You also do it. So that the sovereign credit rating agencies will see you on a comparable basis and maybe you will get a better grade so that you can borrow cheap, you are more reliable, investment worthy, credit worthy, etc. So the fiscal anchor around which your prudence is to be expressed is debt GDP ratio. You want to go to 55.6% in the upcoming fiscal for which the budget is presented. 4.3, are you abandoning fiscal deficit? No. Fiscal deficit and the debt to GDP ratio are two sides of the same coin. Unless you behave well every year, you won't behave well in terms of what you're sitting on, the total public debt of the union government. Let me explain. You know, last year the fiscal deficit was 4.4%. This year the target is 4.3%. There is a huge story between 4.4 and 4.3. 0.1% is what you are reducing it by. What does it mean? It means your GST collections are slipping. Direct tax collections are slipping. Your tax buoyancy, I'll explain that later, is slipping. So, you know, if you had an FRBM telling you to target the fiscal deficit every year, you have to bring it down to 4.4, bring it down by 0.3, that is 4.1. If you are bringing it down to 4.1, you know how much less the government can spend if it doesn't borrow? So this year, you want to be overlooked because you have reduced your fiscal deficit only by 0.1%. Let nobody shout at you, let nobody lecture to you. Next year, if you are more robust, then you can bring all the way to 3.9%. So when you have debt to GDP ratio as a fiscal anchor, you get flexibility. If you have a shock, borrow more. If all is well, borrow less. So what you have is the target of 50% of the GDP being the public debt of the union government by 2031. Not to be bothered by it every single year. Annual borrowing, try be disciplined, but you are not the master of your fortunes. You are living in a world that can go either way. So you have flexibility. So from 4.4 to 4.3, entire year the fiscal deficit reduction is 0.1%. That tells you a whole big story. Look into that. Then you will realize the need for flexibility, fiscal deficit rate adjustment. That is why the new anchor is the debt. You know, debt gives you one, global comparability. Debt gives you another, flexibility for the annual borrowing. Beyond which, you have to be well behaved. Unless you are well behaved on a daily basis, you won't be well behaved on a long-term basis. But, you know, every day you study for 10 hours. On a Sunday you don't. Sunday is an exception. Or on a day when you have to run around, you know, submit an application form which is 20 kilometers away. You may not study on that day. But if the rule is you have to study every day, then you're finished. So flexibility is very, very important for medium to long-term stability. That's exactly what you get here. Please see this. This is what you're looking at for the upcoming fiscal for which the budget is relevant. This is the GDP, you know, yearly borrowing, etc. I've told you everything you need to read. Next time you see an article about it, skip it. Because this is general studies, and if you're going hyper-technical, you're digging your own grave. This is the winner's stuff, you know. So, deficit and debt. Next. CapEx. Yeah, this is very, very interesting. Follow me very carefully. CapEx. You know, capital expenditure. Everyone is praising the budget because, you know, they were praying to the government, don't cut down the fiscal deficit. Borrow. Don't be too sticky about the number. Why? So that you could spend on the economy. So that you can crowd in the private sector, which is very vital for your employment and so on and so forth. Infrastructure, manufacturing, services and whatnot. So, CapEx. Union government is spending 12.2 lakh crore, not spending, allocating. I'll tell you the difference. 12.2 lakh crores of rupees. Total budget, I told you 53 and a half or 54 roughly. In that, 12, that is about 20%. 20, 18, whatever, percent. 12.2 lakh crores is for capital expenditure, rails and roads and inland waterways and airports and so on, telecommunications, all that. In that, 12.2, you give 2 lakh crores to the states as a interest-free 50-year loan. In that, some is unconditional, some is conditional. For example, if it is VBG Ramji, if I'm giving you 60 rupees for that, you have to call it only VBG Ramji. You can't add this name and that name, local name, etc. Also try to privatize your distribution companies of electricity so that they run profitably, etc., etc. So 12.2 is the budgetary allocation. In that, 2 lakhs is given to the states. Actually, it's a grant. You call it a loan, 50 years, who is going to bother? You started it 2-3 years back. 50 years, you know, none of the people in the government will be around. So, Honorable FM is on record saying it's virtually a grant, but we're calling it a loan because that's how it has to be classified in an account book. So, take this 2 lakh this year among you, spend it on roads and buildings and so on and so forth, irrigation dams and flyovers, all that, spent. So how much is that? 10.2 I am spending, 2 I am giving you, loan 50-year interest free outside your FRBM. This is the part of my FRBM. Whatever that is, 4.3. I am borrowing and handing it over to you. This is my revenue. This is a loan, so capital outgo for me. Loan, it is a loan. Grant is a revenue. We'll come to that. So, this 2 lakh that you people have to spend will be outside your FRBM. You don't worry about the FRBM. Spend on infra. Me, I'll take care of myself. This 2 lakh, fine. I'll adjust it within my fiscal responsibility, budget management act, etc., etc. Now, there is another concept for which you'll see the graphic later, but don't switch. Don't switch. Keep it back. So you see, I've allocated, that is, union government is allocated 12.2 lakh crores. But in my revenue expenditure, I am giving you how much? Almost about 4 or 5 lakh crores of rupees I'm giving you. How? Am I not giving you for schools? Am I not giving you for rural roads? Am I not giving you Krishi Sinchai for irrigation? So I am effectively giving you 5 lakh crores. Union government is giving you 5 lakh crores. And this year 12.2. The 5 lakh crores is my revenue expenditure because I'm not investing. I'm giving you and you are investing. So where I directly don't invest, that is in my revenue. So I am causing capital expenditure by you, but for me it is revenue. Here I'm giving you loan. Loan is invariably a capital outgo. So this 12.2, and that's about 5, 17 something. This is called the effective capital expenditure. I've told you everything about it. You will see it in the next graphic. Before we get there, please follow this. This is a very crucial slide for you. Fiscal deficit targets are there. Debt to GDP ratio, target year is there. 11 points. Gross market borrowing, don't remember. Don't remember, but just remember gross market is 17 point something. Net is 11 point something. 11 point something, 11.7, 17.2. Between gross and net, what's the difference? You know, I borrow 17. I borrow 17 gross. And why am I borrowing 17? 5 lakh or something I have to return as the loan. The loan I have taken, 5 lakh I have to return. So I am borrowing 17. In that 5 I'm returning, I'm not using. I have to pay back the loan also, not just the interest. I have to pay back. So I'm paying back. 17 minus 5 is 12. 12 is what I'm keeping. In that, much of it I'll spend for myself and duties. And some of it I'll give you. How will I give you? I'll give you for all the centrally sponsored schemes and central schemes, etc., etc. That's how the rough math works, approximate math. So, quality of expenditure. Within this, see, okay, you're borrowing 4.3. If you are borrowing 4.3 for consumption, wasteful expenditure, then I can criticize you. But if you're spending so much on capital expansion, then the quality of expenditure is very high. So I have to praise you. Quality of expenditure. Special assistance to states, 50-year, interest-free, outside the FRBM, for them. Outside FRBM, these are the important points. Next graphic is, see, this is the capital expenditure. These are the grants in aid under the revenue account. You see, I am giving you money because you are running short of money for your salaries. I'm not talking of that. That's not capital. That is a revenue deficit I'm trying to bridge. Yes? But here, the 4.93, the 5 lakh crores I'm giving you to build assets, roads and inland waterways and irrigation dams and flyovers and hospitals, schools, all this is physical infrastructure for which I have passed on this much money. I would like to add this and then tell you about the total effective, not total, effective capex. Total is not there in the technical term. Effective capex, effective capital expenditure. And here there is this star, here there is star. Why? In this 12.22, there is 2 for states. The 2 lakh you are passing on to the states for all the capital expenditure within the 12.2 is also included here. That should be clear. Next. Yeah. Before we plunge into the tax side of it, I would like to tell you about the gold reform. See, 11 years back, 10 years back, a decade back. You know, in India, we are a traditional type of people. We wear gold and stuff. And also we save gold so that we can collateralize and highly liquid and comes to your relief. They start, you know all that. I don't have to tell you. Now, but then if you are going on buying gold, you have to import gold, and to import you require foreign currency rather than importing. What is essential, if you are importing gold, then you are driving a hole in the forex profile of the country. So, you have the government, RBI that is, issuing government securities, sovereign gold bonds. Bond is a security. So don't buy, I have 100 rupees. I thought, I should put it in gold. I don't care, I don't wear gold. But gold is decent, gold is collateralized, gold is liquid, and so on and so forth. Gold is safe. So this 100 rupees, rather than buying physical gold, I will buy the RBI bond. Physical gold, where do I stock? That is a problem. Somebody can take it away. Problem. So, this document you take, virtual maybe, every 6 months you will get 2.5% of interest also. 2.5 interest payable into installments. Total annual is 2.5, 1.25, 1.25. A little bit of, you can buy a few grams, you can buy half a kg also. RBI issues it left, right and center. This year they are not going to issue, 26, 27, because gold is overheated. And now they are paying through their nose. So you buy, keep it for 8 years, and you get interest every half a year, you get interest, minimum and maximum. you know, uh, it's good for you. A lot of problems are solved. You even get interest and depreciation you get. But price falls also, you have to pick up the bill. This year, last year was extraordinary for gold. For a variety of reasons, you know it as much as anyone does. So the point is this. The point is, this budget is important for two reasons, not the best of reasons. One is good, the other is not. See, what if you had bought a sovereign gold bond in the stock exchange? I want to sell, you buy. I want to sell for any number of reasons, you want to buy for any number of reasons. So, if you bought in 2020 and if you sold it now, you know, I bought 8 years back, let's say 8 years back. 8 years back I bought, kept it for 8 years, enjoyed the interest, interest is taxable. And at the end of the maturity period of 8 years when I sell, my 100 became 120. The 20 is the capital gains, that's not taxed. That was the original norm. And if you bought from me in the stock exchange and you did not keep it for 8 years, the residuary period was only 4 years, and after 4 years you sold, liquidated it, picked up whatever money, you were protected. Even your capital gains were not taxed. But then the government is not able to bear the bill because gold is, the future. I have heard some experts on the TV, serious big experts. I'm also watching the world, the uncertainty, the turmoil, and the de-dollarization, so-called currency war, bring the dollar down by diversifying into gold, etc. So with all this, the government wants to give the benefit of capital gains tax exemption only if you keep it for the entire 8-year period and buy it from the RBI and keep it for 8-year period. But if you picked up from the stock exchange and kept it for a residuary amount of time till the 8-year period expires, 4 years, 5 years, 6, whatever, then whatever gains you are making, you are going to have to pay the capital gains tax. That is the broad rule that the government introduced. So in secondary market, if you pick up the sovereign gold bond, you have to pay the capital gains tax. Also, the government has reduced the import duty on gold from 6% to 5%. Why? Because if the customs duty is high, people smuggle. See, you may be moralistic and stringent and so on. We will not allow anyone to buy gold unless they are ready to shell 6% of the import duty because our forex is too precious and we are in a turbulent world hitting our foreign exchange picture. You shooting yourself in the foot. 6 is stupid. It will encourage smuggling. 4, you will lose money. So keep it 5. 5 so that smuggling can be controlled and you will also get your money. And people's aspirations are met and their needs are met, and also the industry, gems and jewelry, etc., they need gold. So yeah, these are the 2 reforms in the field of gold that the budget has done. Since gold is the hottest topic and these 2 reforms are in the budget, we should know what they are. What they are, what and the why. This is, you could take a look. So sovereign gold bond, the change is this, that if you picked up in the secondary market capital gains tax, from now on, you will have to pay. From now on, prospective. Next, tax reforms. We have some tax reforms, not sensational. See, we already, first let's begin with the silliest. That is not exactly silly because, see, till this current year, you made 100 rupees this year, your salary 100 and taxable this year. This is called the previous year Next year you will find that is called the assessment year. Previous year, assessment year, you can't file this year unless you are advanced tax. So my salary is 100 and taxable at 10, 20, 30, whatever percent. After I've got the salary for full year, next year I'll file assessment year, obvious. Previous year, what is this? So this is a historical hangover from the British times. So IT Act of 2025 says only tax year. This is the year my bank statement. This is the year my salary statement. So this is the year of my tax statement. So this is the tax year. Pay by July, pay by October, whatever. That is the ground level stuff. So instead of the assessment year and the previous year, which is very confusing, the legal code is very confusing, club the two into a single term called the tax year. Makes sense. Ask anyone, it makes sense. So much of relief for laymen. So that is one change. Another relates to MAT. I want to discuss this. Not all this corporate tax, etc. Not that. 30 years back in the budget, union budget, Chidambaram, the then finance minister, he introduced MAT, minimum alternative tax. There's a company, zero tax company. How? Very clever. They use the tax provisions to plan and stuff to avoid not like Tiger Global, avoid which is not evasion, avoid which is planning. So and then they show book profit, notional profit. Based on that, they may even give dividend, but they don't pay tax because the book profit is notional and payment of dividend is from reserves. So they are showing profit, but they are not paying corporate tax. They are zero tax companies. All this is too clever, but the government is not getting money. Therefore, Chidambaram said minimum. Don't pay corporate tax. Minimum alternative to corporate tax, minimum alternative tax. It began with 6% or so. Today it is 15. Tomorrow it will be 14. So now what happens is I'm a zero tax company. I'm paying 10 rupees as MAT. Today I'm a zero tax company. After 2 years, I become a corporate tax paying company. So all these years I've paid MAT of 6 rupees, 7 rupee, 10 rupee, 20 rupee. All this is the credit. So when I pay corporate tax of say 100 rupees, this 20, 30, 40 MAT that I've already paid can be deducted, set off, and the rest I can pay the corporate tax. That has been the provision related to MAT and corporate tax till the current fiscal. But from next year, your MAT is final and it is not offsettable, it is not creditable. If I'm a zero tax company, if I'm paying MAT, I've paid MAT. It is not to be offset from the corporate tax that I will start paying tomorrow when I grow bigger. So that I think is a decent reform, MAT. That is all this, your IT Act is getting modernized. 61 is not there, 25 is there. So this tax year or MAT, for example, are the new additions which are modern. That is one tax reform. Another is, of course, we were all watching the TV yesterday, the securities transaction tax, the financial transaction tax on futures and options. Futures, it goes up by 150% from 0.02 to 0.05. On options, it goes up from 0. Something, it goes up by 50%. It goes up by 50%, maybe 0.5 to 0.75, whatever. So the point is, lot of people are there, they think stock market is the ticket to instant prosperity. Everyone makes money on stock market, let's make money on a daily basis. These people keep playing the F&O and keep losing money. And the F&O market yesterday, a senior officer was saying, is 500 times of the GDP value. To begin with, you can't be so speculative, you will ruin yourself. Let me deter you by increasing the tax rate. If I still can't deter you, at least let me collect some money, because my fisc is also a little wobbly. I have to pick up more money. So for myself, I'll get money. And for yourself, I would like to deter your excess speculative behavior. So on F&O, the tax rate has been increased. Yesterday, all of you have seen the market tumbled. But today the market came back. You know, this is the new, the Trumpian style. Announce something too bad. Everyone knows about it. Start selling, short sell. 2,500 yesterday, it went down. Pick up, bring it back to 400. Sell, 1,500. Buy, sell. And the next day, it's normal. So, you know, that's the Trumpian. Here, of course, it's a genuine fiscal initiative to ensure responsible trading, stable markets, and also some fiscal gain for the government of India. That's one reform that's been done, and I fully endorse it. Wonderful reform. And to invite investment from the FPIs, the thresholds have been raised. More of that can come, etc. So that's not a tax reform. Keep it aside for the time being. So STT is one reform. Tax year is another. And we already discussed the data centers. Data centers are, with their servers, they're providing cloud services to global companies, and the profit they make on that is tax-free. That's a big reform, because data centers are the technology of tomorrow, future, etc. And then regarding the information technology, there is some consolidation. See, what happens is, the government wants it hassle-free. Companies want it hassle-free. Why not have a mechanism for that? So you are an IT company, whether you are customer support or knowledge process outsourcing or BPO or whatever, the definition of IT has been consolidated, harmonized. Earlier, there were doubts about which category you fall into, because tax brackets are different for different categories. So consolidation of the scope of the IT sector. Next is, see, you are an IT company. Your turnover is less than 2,000 crores of rupees. Next, can we have? Unified. Next. No. Previous. Let's go to the previous. Previous. Yeah. Here, yeah. We are talking about this. So your turnover is less than 2,000 crores. Earlier, till this year, it's 300. Now expanded to 2,000. You make profit. After all, you are in business, so you make profit. Tell the department, sir, I want to lock myself in for every year my profitability increases by 15.5%. Take it for granted. This year, 115.5, another 15.5 on that for 5 years. Lock me in, automate it. Safe harbor. What is safe harbor? You don't have to check my books. I will minimum pay you tax according to this rate of compounded annual average increase. 100, 115.5, etc., etc. I'll pay you. Don't have to check my books manually. Automate it for 5 years. If I can't pay you less than this unless some escape is there. Escape means legitimate escape. Sir, everything crashed and I'm zero at. We can negotiate. But the norm is lock me in. The harbor is safe for me. I cut a deal with, I enter into an agreement with you for 15.5 on an annual basis, 15.5 on that 15. And you don't have to check my books. As long as this agreement is reached, the harbor is safe for me. That is, you won't check my books. My tax compliance is taken to be perfectly, I'm compliant with the tax norms, etc. So earlier it used to be 300 turnover, now it is 2,000. Consolidation of the definition and the safe harbor principle of 15.5, etc. Yeah, this is IT tax rules changed, MAT redefined, tax year, data center, STT. These are the tax reforms of the budget. I don't think they are tremendous, but yeah, they are the reforms. These are the concepts. There's a concept called safe harbor, we know. If you follow the rules, the harbor is safe for you. We won't come, knock on your door. We won't come, check your books. That is safe harbor. Follow the rules, all is well. Harbor is safe. Presumptive tax. You know, having the services of a CA, keeping the books, all this is so costly, so expensive. So, for people of lesser turnover, what the government does is, under this threshold, we assume that your profitability is 10%, 10 on 100, you made a profit of 10, on that you pay this sort of a corporate tax. There is a threshold below which you are assumed to have made profit only X amount of profit. Don't keep books, don't come to us. Just pay the presumptive tax, the tax that is presumed to be applicable to you. Because you can't keep the books. Actuals you can't. So these are the concepts in the tax reforms. Next, let's see. This we have discussed. This is important. Tax buoyancy is very important. See, the tax buoyancy is, economy is growing. With the growth in the economy, what is the level of growth in the tax collections you are witnessing? After all, the government is facilitating the growth in the economy with so much of investment, and that investment is possible only if the government collects taxes from the people who are benefiting from the growth of the economy. So, just imagine, this bottle, maybe 5%, maybe 18% tax I have paid. A perfume, 28% I paid. Yeah. So, when the economy grows, tax collections also grow. Direct and indirect. Direct is corporate and income, STT, etc. Indirect is the consumption, GST, excise, VAT, basic customs duty. So, the responsiveness of the tax collections to the growth in the economy, that is called buoyancy. Buoyancy happens because, if agriculture grows, what is the buoyancy? May not be even 0.1, because agriculture is not taxed. If bread and butter, essentials, the growth is there, what is the tax you collect? Nil. There is no tax on atta. So, if the fiscal system is based on principle of progressive taxation, if the luxury economy grows, you will have lot of collections. GST 28%, etc. Income tax 39%. Corporate tax, companies grow. Formal economy, lot of tax collection. Progressive tax, lot of 30%, 40%, etc. Lot of tax collection. And also digital enforcement of tax laws for greater compliance, etc. These are the initiatives of the government that help the government collect taxes in line with the economic growth, the GDP. Which means, see, I have salary. I come in the 10% bracket. And my salary goes up because the economy is growing. I jump into the 20%. 20%. I work even harder, economy grows even more. 30%. Company makes profit. They use the AI, cut down the cost. Profit is more corporate tax. And with the profits, they play around in the stock market. This, that. So when the economy grows, different sectors of the economy paying different rates of tax, on average, the responsiveness boils down to a certain level of tax collection for the given 1%. GDP grows by 1%. What is the rate of growth of the tax collections? That is the buoyancy. And I have told you the factors responsible for the buoyancy. in India, see, you can't have it both ways. IT exemption limit 12 lakhs. GST, a lot of the 12 became 5. So tax collections have fallen. You know, direct tax collections are 1.14 is the buoyancy. But this indirect tax collections, customs duties you have reduced, GST you have reduced. They have fallen to about 0.4 or something. On average, the buoyancy is 0.8. So direct taxes are 1.14 buoyancy. Indirect taxes are about 4%. On average, it is about 8%. Upcoming year, 26-27. You know something you will hear a lot about, because there'll be a lot of criticism, appreciation, all that. But this is the reality. Tax buoyancy, the levels for the two, the direct and the indirect, the average, upcoming year, the factors responsible, the conceptual definition, let's see it. Yeah. If the economy grows by 10%, tax collections also grow by 10, it is 1. Grow by 11, 1.1. Grow by 9, 0.9. That is how it is measured. This is important. I have never seen this in recent years. It never fell below 1. We used to flare up to 1.25, 1.3 also. But this year, for no reason, because of the whims and fancies of one person, the richest country in the world, richest means 40 billion, 40 trillion, 38 trillion, it is here. We are not able to export. We are not able to make. We are not able to collect the GST. We are not able to employ. We are not able to have consumption. Again, there is a pressure on GST, and then income tax, and then corporate tax, and so on and so forth. 0.8 is something that strikes you as a shock. Collecting units, 0.8. Why this matters, etc., etc. The trade-off to keep the fiscal deficit. So if the tax buoyancy is 0.8, you have to borrow more. That is why the Honorable FM did not cut the fiscal deficit more than 0.1% between the current year and the next year. Because there is no point sticking with a puritanical number of fiscal deficit. You have to be in line with the macro conditions and the immediate prospects of the economy, the global turbulence. Trade-off. Next. Tax buoyancy, some more. 10%, etc. If you formalize the economy, ask them to employees provident fund, etc., give them incentives. Once they are there, they are formal economy and they start paying the tax. Informal, however big you are, you don't pay tax, except some consumption taxes. So formalization, corporate profitability. Tomorrow there is a question in the prelim, the tax buoyancy is affected by ABC. These are the factors, and that triggers your mind and you'll think even more, and then you'll get it all right. Next. This I have discussed. The 15.5% rule. And then from 300 to 2000 it's gone up. Nobody will come to your place. There is no human touch at all, fully automated. For 5 years locked in. Unless something hugely abnormal happens. Next. Interesting. This is very interesting. See, you have the budget receipts, revenue receipts, capital receipts. Capital is very clear. The loan that you take and the loans that you recover. You gave a loan, comes back to you. You take a loan. But the third one is this. Miscellaneous capital receipts. Damn good question for your whatever the occasion. Miscellaneous capital receipts. Earlier the entry used to be disinvestment. Now it is no longer just disinvestment. Miscellaneous capital receipts are basically two. Disinvestment, which can be privatization, Disinvestment can be selling shares or selling shares to one corporate entity and give the unit over to him. Sell it. Privatization, strategic sale. Or just selling shares and keeping the company for yourself. The other is asset monetization. Asset monetization. There's a land there or there's a road there. You're not able to pick up any toll for that. Or the toll is not adequate. You're not able to pick up any toll for that. That road, there is a InvIT, Investment Trust. They are ready to give you 30,000 crores of rupees for the next 10 years. Give them the right to collect the toll. After 10 years, returns to you, and then you may renew, etc. The asset which is passive and stagnant, you are monetizing it. Similarly, this budget talks about a wonderful concept. Here, terrific concept. Real Estate Investment Trust. I'm there. The Government of India is there. They have lots of buildings. People are paying rent 50 years back, 10 rupee rent, 100, 150 like that. Or no rent at all. So they have buildings, they have roads, etc. Group them together, give it to a REIT. There's a REIT, he tells people, I'm issuing units for 30,000 crore. You buy. I'll collect the money like a mutual fund, 30,000 crore. Give it to the government. And the government will give me those buildings and warehouses and staff quarters, whatnot. Give it to me. Take this 30,000 crores, government gets the money, I get the government assets, I collect the rent. How much do I collect? 1,000 rupees. All the guys who bought my mutual funds, the units of REIT, they'll get the dividend. Anytime you are sick of me, you want money, I'm trading on the stock market, get out. People will come, people will go. There are inflows, there are outflows, I keep going. And the government got its 30, I get my cut, you get your dividend, your capital could also be appreciating. So everyone's happy. The stagnant, passive assets of the government are activated and they are lucrative through we all have heard the finance minister say REITs, Real Estate Investment Trust, property mutual fund you could call it. InvITs are also there, but she didn't talk about InvIT yesterday. Infrastructure Investment Trust. Infrastructure Investment Trust. That is, I talked about staff quarters, warehouses, etc. If you are giving me money for roads, roads, and maybe airport, etc., infrastructure. Real estate is one thing where the rents are collected. Investment is something for infrastructure. Infrastructure, investment. Real estate, investment. Both are trusts. Give me money, I'll buy for you, I'll give you annual or whatever returns, and whenever you want the money, I'm trading, you get out, liquidate. So this is what I found to be very useful for our occasion. Asset monetization along with disinvestment together makes up the miscellaneous capital receipts. There's a new entry into the budget. You know, if you had looked into the capital receipts side of the budget, a few years back you would have only disinvestment. Now you are seeing this. So I thought the examiner's attention is also grabbed by this change. And the rest will be history. Next. I've explained to you what REITs, Real Estate Investment Trust, is. Exactly that is, found here. Next. Very, very important. tax trends. We have just now talked about. This is Government of India. This is Government of India. Not the Government of India plus the state governments. No, not the combined. Only the Government of India. Gross tax revenue is this much of the GDP. Gross tax revenue, GTR. Direct tax is this much. Direct tax is this much. That is 6.9, 4.3. 11.2 adds up. 6.9, 4.3. This is a projection for the upcoming fiscal. This is the fiscal which is running. So 11.2, see, indirect is 4.3. Direct is 6.9. Direct is corporate and income. Income is more than corporate. And STT, yesterday we have heard the government person saying 15,000 crores of rupees is what they are expecting from the STT increase, the rate increase, F&O. So the point is this. This is direct, this is indirect. Direct is much more than indirect, actually 2/3 and 1/3, almost out of 11.2. If you combine the center and the states, direct is progressive. You have a lot of income, you pay a lot of tax. You are a company paying profits, you are making capital gains, you are, operating in the stock market, F&O, they start. So direct is progressive. Indirect, the poor man and the rich man, both of them pay the same rate. I gave you the example of a bottle of water. Whoever buys this Bisleri bottle of water pays the same GST. So indirect should fetch more. And if you combine the center and the states, the ratio is this becomes indirect, this becomes direct. So here direct is fetching you more. If you combine the center and the states, the reason is all the direct taxes, almost all, are in the hands of the center. States have only VAT they have, liquor they have, and related indirect tax. VAT and liquor are the ultimate, stamp duties, etc. So the point is, states have indirect, center has direct and indirect. In other words, if you combine center and states, this direct prevailing over the indirect is reversed. Indirect prevails over the direct. That becomes 2/3 and direct becomes 1/3. Let's get the graphic. Here it is. This is central government. Let's, 2/3, 1/3, that's okay because this keeps shifting. But the essential ratio is 2/3, 1/3. This is central government only. Remember, now you flip. Next one, next one, next one. Next one, yeah. The combined center and the states, indirect is 65, direct is 35, 40. For both, if you could have direct prevailing over the indirect, you have arrived. The country is progressive and the vulnerables are protected. But then realistically speaking, consumption is a fact of life. Whoever you are, you have to consume. We'll get you there when you are consuming. Because in India, the direct taxes, you see agriculture not included, too many poor people, too many exemptions, and a whole lot of other things. So this is how the reversal takes place when you combine the two. Indirect, 2/3. Direct, 1/3. Next would be, this is, if you have a macro big picture look at the budget, it's a budget for stability. Take fiscal, 4.3. You haven't been adventurous and puritanical here, both, So fiscal stability, and then you've got a committee for financial sector reforms for Viksit Bharat, and that is a financial stability. And then you are getting foreign portfolio investors, raising the threshold of investment for them, stock market stability. Also, you're preventing excess of speculation by raising the STT, stock market stability. You are reducing, you have zeroed the import duty on nuclear materials, so there is energy security and stability. And then you don't want to be vulnerable to critical minerals, etc. So you've got the corridors coming up. you got the resource stability, and then you got the semiconductor mission 2.0, that is technological stability, data centers, semiconductor mission, etc. So this budget plays for stability. Stability is, see, if you reduce your fiscal deficit too much, then you are vulnerable. Stability. Link your debt to GDP. That is also stable, leaving you with enough room to adjust yourself to a variety of global and domestic economic challenges. So that's how you, see stability across the budget. Next. That was the budget. We have done as much as we could on the budget in the given the borders of time. So now, luckily for us, we are discussing today. Yesterday, the Honorable FM said, I am tabling the 16th Finance Commission report. It was given to me, given to the President in November, headed by Arvind Panagaria and other members, given to the President in November, and the President accepted the recommendations. So I'm tabling it today. Yesterday it was tabled in the Parliament, and by evening it was up on the Finance Ministry website. So there one could not, plenty, wealthy information will be there. It takes quite a bit of time to go through that, at least a week or 10 days, Super information is there. But for the upcoming examination, I can trigger the tracking of the 16th Finance Commission with two details. Very, very interesting. See, yesterday, all of us remember the Finance Minister said vertical and horizontal. She talked of vertical, like 41%. J&K is a UT now. If J&K was a state, 42. Encassing Commission, the 15th one said J&K money will give it to center. It will not be a part of the state's corpus. So that the center gives it to the J&K. So from 42 to 41 he made it. So 41%, you see, you give it to the states. But there are 28 states. Who gets how much? Different criteria are there. One is the poverty criteria, that is the inverse of per capita. Another is you have performance, demographic performance, and contribution to the state GDP. Then you have structural, which is area. Then you've got population, which is also structural. There are people, you have to take care of them. Then you've got the forest. So there are 6 criteria. Poverty criteria, inverse of per capita is 47.5, 42.5. And then the population of 2011, that is 17.5 here. And that finishes 60%. Area, forest, demographic performance, and the state GDP, 10 each. 4 tens are 40. 40 and 60 is 100. That's how the money that they get, the states, a horizontal distribution, the criteria and the weights are given in this table. I made the table. The Finance Commission report is big. This is very, very interesting. Next is, no, please proceed as you did. Yeah. Next, This is very interesting. I'm not a student of math, but I'm interested in it. See, state GDP, okay. You are, let us say, this Maharashtra, Gujarat, Tamil Nadu, Karnataka, all that. UP for that matter, huge GDP. Today the UP GDP is about $360 billion. UP wants to be $1 trillion. It will get there, because if you want to make it to 30 trillion in 47, you can only get there via UP. There is no other way. So the point is, the state with 4 rupees of GDP, state GDP, there is a state with 100 rupees of state GDP. 4 and 100. Which means 25 times the big state has to get in comparison to the small state. So what they have done is a square root solution. So let's take the example of 4 rupees. Let's take the example of 100 and 4. 104. So it seems the square root is, what is a number whose multiplied by the same number gets you 100? 10. What is a number multiplied by the same number gets you 4? 2. So 400, 25 times. 2, 10, 5 times. So the money that is allotted to the states based on the state GDP will not be steeply different 25 times between the biggest and the smallest when you apply the square root solution. That is what I have found in the report. Because the steep differences among the states are likely to perpetuate the inequality and the imbalances. Therefore, they found the square root solution. This seems pretty important for your everywhere, prelim, main, because for whoever is interested in fiscal federalism and the Finance Commission were very curious about the report, couldn't read the report, and reading a newspaper about this report won't satisfy your curiosity, went into the report, and this is very interesting, very, very interesting. I've never seen this before. I've never seen a lot of things like in the 16th. They scrapped Article 275 grants, revenue deficit grants, they scrapped. And exactly the same amount that the 15th Commission said give, they said give that much only. And further they said, square root you apply in order for inequality to be not perpetuated, for contrasting states to be treated rather equitably. I've never seen anything like this before, but then it's very interesting. Next. That's all. See, friends, I have done my part. It was lovely talking to you. You got some questions you could ask me. It was lovely. I could have gone on for another as much time. Anyone with a question? And here, wish you all the best.